Okay, good afternoon, everyone. Welcome to the investment meeting for March 15th, 2022. Joining us today, Graham Stanley, Mark Potter, Doug Anderson, and Dmitro Yamskovich. The ICM meeting, which we do each week, is our opportunity to discuss as a group the economic, political, and market trends impacting our portfolios and our trading decisions. Today, we're focused on the Russia-Ukraine conflict, the impact of inflation trends, and we'll spend some time discussing the FOMC meeting this week, which is coming tomorrow on Wednesday. Okay, as always, let's get to work. So the war in Ukraine continues. These headlines are from the Wall Street Journal from yesterday. Each day the peace talks between Russia and Ukraine continue. They make little progress as the Russian offensive continues to grind on. In yesterday's news headlines, a lot of discussion about China's role in this. Is there an opportunity for them to be a peacemaker in the process, or will they continue to align with Russia, as we would expect they will? US and China had high-level meetings yesterday, described as being intense. I'm not sure there was really any resolution from that, but at least the dialogue is going on between the US and China on this matter. Tomorrow, Ukraine's President Zelensky, as he has been speaking with foreign leaders and foreign governments, he met with UK last week. Today he met with the Canadian Parliament, and tomorrow meeting with US Congress virtually. Sometimes, just to get some context, it's good to take a look at the varied maps that are being created now and updated daily, showing the current situation of the war. The map on the left is from, in fact, Wikipedia, and the second map is from the Study of War. Both show the aggressive stance Russia's taken on all sides that border Russia and also border from the sea. And you can see here where Russia's been pushing in on all sides very aggressively. And I'll let you take some time after this meeting to go through these maps on your own. There are certainly pockets where there's been strong Ukrainian counteroffensives, or certainly a Ukraine protest against Russian occupation. That's highlighted here in these blue cities. But again, remains a very tense, desperate, terrible situation, and the war continues. I'm going to take a moment here and just we'll tune into Ukrainian President Zelensky's address to Canadian Parliament from this morning. I think it's just important for us to gain some context and to hear from the Ukrainian leader. And so let me just press play. We'll listen to about 2 minutes of the clip. Otherwise, the whole address and the commentary from Canadian Parliament before and afterwards is on YouTube or on the news channels.
Speaker Fury, party leaders.
Let me just skip forward here.
It used to be, we were a very peaceful country, peaceful cities, but now they're being constantly bombarded. Basically, what I'm trying to say that we all need to do, you all need to do more to stop Russia, to protect Ukraine, and by doing that, to protect Europe from Russian threat. They're destroying everything, memorial complexes, schools, hospitals, housing complex. They already killed 97 Ukrainian children. We are not asking for much. We're asking for justice, for real support, which will help us to prevail, to defend, to save life all of the world. Canada is leading in these efforts, and I'm hoping that other countries will follow the same suit. We're asking for more of your leadership, and please take more, greater part in these efforts, Justin and all of our friends of Ukraine, all friends of the truth. Please understand how important it is for us to close our airspace from Russian missiles and Russian aircrafts. I hope you can understand. I hope you can increase your efforts. You can increase sanctions so they will not have a single dollar to fund their war effort.
I'm going to pause here. I'll let you watch the full address on your own, but there's certainly an important moment as Zelensky addresses the Canadian Parliament, asking for further support. We know that that the U.S. and NATO are not complying with his request for to shut down airspace over Ukraine, but certainly he's asking for more support, more military support, and continued sanctions. Which that's the one thing that Canada and the Western nations have been able to do. So interestingly, Russia came back today and is sanctioning U.S. officials and even Canadian officials. It's just a token effort, but I think that these sanctions have been a key aspect of what the West has been able to do. Hopefully, we can continue to do more. As we stated before, the Ukraine-Russia war is having a big impact on the markets, and there remains a high level of near-term uncertainty. And our equity portfolios are maintaining a defensive position with higher than normal cash balances as we work through this. The key events this week, certainly this morning, PPI numbers came out, producer pricing inflation. I'll comment on that in just a moment. But tomorrow, FOMC meeting, that's going to be a major focus for the markets. We're going to be watching for an interest rate increase in the States. Now, before the war, we were expecting a 50 basis point hike. We're now expecting a 25 basis point hike tomorrow. But certainly in the Fed statement and the news conference following, the market's going to be looking for the tone and some guidance from Chairman Powell. At this point, Goldman Sachs, as an example, is expecting 7 rate hikes this year, followed by 4 rate hikes in 2023. That would take the terminal rate the Fed funds up to 2.75 to 3%. We're also expecting the FOMC to finalize and publish its balance sheet plan at the end of the May meeting, and expecting some comments on the balance sheet tomorrow as well. Now, just turning to the inflation numbers, PPI came out today following the higher than expected CPI number from last week. In February, PPI coming in at 10%. They also revised January's number from 9.7 to 10% as well. So this is now the 21st straight month of month-over-month rising producer prices. And we know that this is being caused by the pressure from the supply chain and what they call intermediate demand. This certainly isn't a transitory event. This is going to be with us now for some time. Interestingly, in February, 40% of the increase for final demand goods can be attributed back to gasoline prices, which rose by near 15%. And here's a chart here of a US PPI closing in on 10% here. Now with the FOMC meeting for tomorrow, here's a chart looking at the expectations across the street for interest rate probability for the US. We can see here that by the end of the year in December, the market's anticipating near 7 quarter-point rate hikes. So this will be the first time that the Fed has raised rates since December 2018. And I guess the key question is going to be is the expectations are for a whole series of hikes, and the Fed will only pause if it thinks that tightening risks pushing the economy into a kind of a material recession. I think we can anticipate a slowing of the economy. It doesn't want to crash the economy, so it's going to have to try and find that balance. And this is one of the uncertainties that we have with the market setting the pace for 7 rate hikes. Canada, we're expecting upwards of 6 rate hikes. Deep down, we do wonder, can the economy withstand such an aggressive move at this time? So we'll keep on top of this. So we'll keep this as an ongoing dialogue in our weekly meetings. Also of note, I mean, this is a critical time where interest rates are being increased, but also the quantitative easing, the bond purchasing by the Fed is going to be stopped. This is the schedule for the recent purchases by the Fed. March 9th will be the last of the Fed's formal QE purchases of about $4 billion last week. And since March 2020, the Fed's balance sheet has risen by nearly $5 trillion due to QE and during the pandemic. The Fed will continue to buy bonds, but they'll do so to offset maturing bonds and to keep its balance sheet stable. So, this is a changing environment. The effects of QE and low interest rates have provided a lot of liquidity to the market. And what this means for us is that we need to reinforce our risk management because of this key source of liquidity for the market is ending. And this is where all the work that we do on our fundamental analysis is so critical. Given the low rates and the Fed's QE program, we can see here that since the financial crisis in 2008, that's been a big contributor to the S&P 500 returns. This is a chart here of S&P 500 total return valuations. We can see here that valuations are still high by a historical standard, and as the Fed is removing its accommodative stance, it's going to make it hard for the market to justify overpaying for assets. So when we talk about reverting back to the mean, that's what we talk about. And it's going to be important for us to make sure that what we own, we're not overpaying. We're paying a fair price for the stocks and the other investments that we own. And that's why, during the heated times in the market, we really didn't participate in the super high growth parts of the market, especially in the US. We always maintain a diligent decision-making process for new investments, and we'll keep that in place. Here's a chart here that shows the Fed's QE and the S&P 500. Certainly the first QE occurred during the financial crisis, and then there's been a series of quantitative easing programs over the years. And the chart shows the correlation between the expansion of the Fed balance sheet and asset prices. And here we are here. Certainly the logic would say that the contraction of the Fed balance sheet will be a negative for the markets. And with the market's discounting process, it remains, even with all the abundant news headlines, this remains the primary reason for the negative start to the markets year to date. And this chart here, Goldman Sachs compiles a widely used global financial conditions index, and it shows here that we're currently back into the tightest financial conditions we've seen in the past 2 years. And if you exclude the March 2020 pandemic, the last time that the financial conditions were this tight, the Fed funds rate was about to hit a cycle high of 2.5%, as opposed to where we are now at about 0.25%. So the difference here is that this was at the kind of a high in the Fed funds rate, whereas here we're coming in from a low, anticipating tightening. So a tricky environment to work within. Further, I thought this was interesting because it reinforces the impact of leverage in the market. And so this is in blue chart of the margin debt as a percentage of real disposable personal income, looking back over time. So we're certainly at a high point in terms of the use of leverage. And while the financial markets and the financial system is currently stable, if things were to become rattled in a material sense, things can become unstable pretty quickly when there's this much leverage in the system. So again, this is something we need to be aware of as we make decisions. Leverage can add to volatility in the markets, especially. I mean, certainly it's easier to absorb during up markets, but during down markets, the unwinding of leverage can be difficult. So then we look at the FOMC scenario analysis. So the best case scenario for the Fed would be able to get to a neutral Fed funds rate and to ensure that the 10-year bond yield rises enough to prevent an inversion of the yield curve, but not enough to lead to a tightening of financial conditions. So if they're successful, over the next 12 to 18 months, we'll see the 2-year US Treasury yield at about 2.25% to 2.5%, and 10-year yields at 2.75 to 3%. And then we'll see inflation hopefully coming back down towards its longer term trend lines. However, if we see the 2-year yields above 2% and the 2-year yields below this level, that's inversion. And that would indicate that we are in or heading towards a recession. And then on the other hand, if the curve steepens too much and the long end yields 10 years are notably above 3%, then there's a risk that financial conditions have tightened too much given the global debt load. So the Fed is trying to thread a needle, and it's possible that inflation will give them almost an impossible task. It's going to be a tough job, but let's keep an eye on these numbers, in particular the 2-year and how the 10-year responds to that. Currently, the 10-year has jumped up, closing today just under 2.15%. We've mentioned this in previous meetings, but the overnight interest rate spreads indicate that while we're on the cusp of a interest rate hiking cycle, the options market is starting to anticipate that we may see lower interest rates in about 2023. So we're just moving into a higher cycle right now, but the markets are anticipating that we're going to move into a recessionary environment, hopefully not too hard a landing, but now the case that it's going to force the Fed to, in effect, lower rates after this hiking cycle in 2023, 2024. So we'll keep an eye on this, but because this would be an indicator for a recession in the coming years. And we look at the scenario analysis for the markets. This is just more of an interesting fact, but something for us to be aware of. So we've started the year off with the S&P down about 10% for the year. and closing, I think yesterday down about 12%, after today near 10%. So how did the markets historically perform after a minus 10% loss in the first 2 months of the year? Well, we've had massive rallies in about 75% of the cases, as you can see here by this table, except in 2008. So we'll see how this year ends up. We're going to keep doing our hard work to make sure that we are as insulated as possible from market downdrafts while performing. The companies we own, especially on the Canadian side, have been performing well. Strong dividends, dividend growth. We've been really insulated from a lot of the volatility we've seen in the U.S. markets. And in the U.S. markets, we've been really careful making sure that we're positioned in good, strong defensive parts of the market. In fact, we've made some changes over the past couple of months. We increased our positioning in the energy market through Chevron and bought Deere so that we're positioned in the agriculture sector through their equipment. Those have been productive trades, and we've also just completed a full rebalancing across our U.S. portfolio. And I think we're actually quite well positioned in this environment. So we'll keep up that hard work. And as we mentioned before, these are tough days in the markets. And as we know from our SAM principle number 2, the worst environment is the greatest opportunity. So it's our job to keep on top of that. We'll leave it there. It's been a busy day, and we'll close the meeting here and then separately continue and just walk through our portfolio and just make sure everyone's up to speed. Okay, thanks everyone.